Pranjul Bhandari joins us, Chief Economist with HSBC Securities. Pranjul, good morning. Thank you for joining us. Pranjul, on paper, it's great what we've heard on Friday. But more than getting euphoric, you think we should get realistic? And the realistic approach is that this tax cut will take its time before it will actually kick in?
Yes, I think you've got it absolutely right. There are definitely some short-term positives out there, but things will take time in order to have a proper growth impact. So, for example, in the short run, there could be a sentiment boost if companies cut prices to consumers during the festive season. There could be some consumption demand, but I'm afraid at this point we're not going to see investment rise a lot, which a lot of people are hoping for. And the reason is that demand is still very weak. Rural and urban incomes are still very low. They are not demanding many things. Capacity utilization is still very low. It's going to be a long time before capacity utilization rises and then firms begin to think about new investment plans, generally speaking. So you are right that there is definitely some sentiment boost now, which could be positive for growth, but the real kick will come in the medium term.
What about the fiscal slippage risk? There's bound to be some element of that. Pranjul, the government saying they're going to review those numbers closer to budget. But talk to us about the greater implication of this on the economy as well.
Yeah, sure. So, look, the fiscal cost is likely to be 0.7% of GDP annually. That's what the government announced on Friday. Of this, two-thirds, which is 0.45% of GDP, will accrue to the central government and the remaining to the state governments. Now, this means a very high fiscal deficit. The government had budgeted 3.3% of GDP fiscal deficit for this year, the central government. That could become high. By our own estimate, it could go up to about 3.7% of GDP. And on the back of this fear, we had the bond yields selling off 20 basis points on Friday. This has to be an area to watch out for, because this is not just a one-year thing. Whatever happens this year could also continue into the next year, because the corporate tax cuts are permanent in nature. And also remember, next year we won't be having the RBI excess dividend, that extra 0.3%. So the pressure will continue. Also, it'll not just be central government. It'll also spill over into the state finances, because they were also getting money out of the corporate tax receipts. 1/3 of the corporate tax receipts used to go to the states. So the fiscal situation is something to keep an eye out for. In the weekend, the finance minister, according to media reports, said that they will not be cutting expenditure, which basically has two implications. One, that the fiscal deficit will be high, the numbers I was talking about, 3.7%. Or two, they really ramp up on disinvestment receipts. Now, the stage is set in some sense. Equity markets are up. So there could be a huge wave of disinvestment in the economy, which would be good for growth. It would be good for fiscal finances. But, let's wait and watch, because we've had some false starts on the disinvestment front in the past.
Yeah, indeed. So, Pranjul, what's your worksheet throwing up? What number? What could be the slippage when it comes to the fisc?
So look, we are working with 3.7% of GDP fiscal deficit for this year. Next year will perhaps be, the same, quite elevated. We're also building in some increases in state fiscal deficits. They were budgeted to be about 2.5%. They could be slightly higher. So these are the kind of numbers we are going ahead with at this point.
Let me play a role of a compulsive bull. A compulsive bull would say that when slowdown happens, it shocks you. When demand comes back, it surprises you. Could that be an element which cannot be captured in the balance sheet right now? It cannot be captured on an Excel. Macroeconomist would not hazard that guess, but that is the magic of cycles, that when demand comes back, it will just surprise you.
Yeah, look, fair enough. I think that's a great point. And especially because you have put on all your taps, you're doing a huge monetary policy stimulus, 110 basis points rate cuts already been done. We are expecting 50 basis points more. So huge monetary easing. And now you also have a really substantial and hefty fiscal easing. And perhaps one can argue the right kind of fiscal easing. Corporate tax rate cuts can also have a lot of medium-term impact. So when you put on both the taps, at some point, the the impact on the rest of the economy must show up, and that is why I also have growth numbers increasing from FY20 at 5.9% to 6.5% in FY21. So that's the reason we have growth increasing, just the impact of all the policy stimulus that we are seeing out there. The reason we are still sub 7% is because you have to put India in the global context. At a time when global growth is slowing, global trade is very weak, I don't think India can really shine and go up to your 8% kind of growth which we were used to about a decade ago. So we will have to be realistic about what India can achieve given the global backdrop. But in that backdrop, I think there is a recovery that we are going to see in the second half of this year and then also next year.
Pranjul, there's an expectation that it's government capex that's going to lead the revival in demand, and that push on that front is still required and may be at risk given the current pressure on the fisc. What's your take on that?
Look, I'm a big believer of government capex in a fiscally responsible way. When we can stick to our fiscal deficit and still increase government capex, we almost always crowd in private sector capex, which is our ultimate goal. So I'm a big supporter of that. The only way I think it can happen in a responsible, sustainable way is by doing asset recycling, in which the government keeps selling a lot of the assets it owns in terms of airports, roads, and so on, and uses that money to build new airports, new roads. So that is a cycle I'm hoping will kick off. In a way, it's very similar to disinvestment. So I believe this whole disinvestment and asset recycling cycle can kick off now, especially if equity markets and sentiment are buoyant as they have been since Friday. Let's see how long it lasts. If it does, then I think a new cycle of asset recycling could arguably start.
So, Pranjul, what is your experience been when it comes to low monetary policy and low interest rates and low taxes? If that was the case, then economies like China would have not slowed down and Japan would have never seen this kind of a slump. I mean, in China, rates are coming down, tax rates are low. In Japan, rates are low, Europe rates are low, but nowhere an investment cycle has picked up. How come a very basic fact is something which equity market people are ignoring?
Well, your question is very good, and it sort of deserves a good answer. What we've seen in the last, the whole globalization period when China really soared, we saw many cycles moving together. There was a very strong trade cycle, global capex cycle, and global manufacturing cycle. Almost all countries took part, almost all countries gained growth across the world, even in India was strong. This cycle has fallen off, has become sluggish now. This is the trade, capex and manufacturing cycle. This is across the world. It's in China, it's in the US, it's in developed and developing countries. You cannot fight that wave of a global cycle turning. What you can do a little bit piecemeal at home, you can run some sort of expansionary fiscal and monetary policy like we are doing, like China is doing. And under those global constraints, you can try to increase your growth. But it won't be like what it was when China was growing at 8 to 10%. It's not that world anymore. So we have to remember that. But having said all of that, if you cut rates so drastically as we've done in India, and you give a fiscal stimulus, under those global constraints, I do believe growth will inch up a little bit, and that's why I have growth picking up slightly in FY21.
Then for the year, let's just get your consensus view on that. Would it still be a little lower, or do you see a substantial improvement?
Well, look, for the year as a whole, this year, FY20, we have GDP growing at 5.9%. The first quarter has been 5%. So we do expect a recovery in the second, third, and fourth quarter. I would be more inclined to say that in the fourth quarter will be the best because second hasn't been very much better. Third will likely see some improvement, and fourth will be the best. So in that sense, I am expecting some higher growth in the second half of the year compared to the first half of the year on the back of improved sentiments and also some monetary transmission. But having said all of that, let me be very clear that my growth numbers are below consensus. I'm at sub 6% at 5.9%, even after seeing this corporate tax rate cuts last week, for all the reasons that you mentioned, that demand is weak. How far could a supply side measure go?
Pranjul, thanks so much for joining us. Good talking to you. And 5.9%, but I think today markets are more focused on the opportunity there in equities.